the right numbers are going in the right direction. The growth and inflation story is good. It's still good. We've seen just phenomenal numbers coming out. The PMIs weren't great, but before that, look, numbers from Friday, when you have durable goods, you have consumption, expenditure numbers, all pointing to the fact that our economy is doing well right now.
All right, let's move away from the data, and I wanted to ask you about another factor that's really contributing to those moves again today, and that's those oil prices, because they seem to be holding up relatively well today again. We saw, we've been seeing a pretty solid rally recently. Take us through, I guess, really what's holding up that sentiment at the moment.
You know, it's pretty simple, and it's like three things. The major thing is that oil was deeply, deeply oversold when it was trading down below $30 a barrel. And it was clear. And for weeks I was saying that the sentiment was ruling the market. It didn't deserve to be as low as it was. So it might not be rallying because things are great. It's just sentiment has turned around. On the other hand, U.S. shale producers have stepped up production cuts. It's becoming more evident. It's deaccelerating quicker than most people expected. And the last thing is you have OPEC countries taking a page from Draghi's playbook in 2012 and issuing all kinds of provocative statements, helping give a tailwind to the market.
Well, it's interesting, Larry, because I guess if we put all of that together, you know, despite those sort of positive factors, I guess, sort of all coming or lining up there, we're not really seeing investors rushing out to buy these US energy companies. So I guess they are still pretty cautious.
Yeah, exactly, and probably should be, with downstream capital expenditures still having to run through the balance sheets and maybe a few more quarters of declining revenues for the energy companies. That's all true, and you know, I think it's prudent for people to wait a little bit and to see what happens to the sector, not trying to find the bottom of the market, but seeing if we get some lift. And we may not see that lift for another few years. There's nothing to say that oil can't go back to $45 a barrel and energy would still not be a good buy here.
Just in terms of the broader market and where we're seeing it at the moment, because February, if we see, you know, how that closed out, I believe it marks the 4th consecutive monthly slide for global stocks there. So, you know, not a good month. But since I think it's about February 11th, we have seen those stock markets rallying about 5% or so. So I guess, you know, signs that we're seeing financial tensions easing in China, and I guess you know, the slumping commodities abating somewhat. Do you think we're through the worst of it, Larry?
Yeah, I do. I mean, just consider the fact the middle of February, February 10th, February 11th, the S&P 500 was trading about 150 points lower than it is today. Not a whole lot has changed in the fundamental narrative between then and now. Sentiment clearly has turned around, and also people are getting a lot more excited about the upcoming catalysts. We already had the G20 meeting, but we're having the Bank of Japan. We have China meeting, ECB coming up, and also the Fed. So there's a lot of tools left to their disposal, and I think people are just realizing the market itself is oversold. Now it's quickly getting to a point where I think it's overbought on a short-term basis, but I'd rather see it overbought than oversold.
I guess one of the other catalysts is on the political side of things, and I wanted to ask you about that because, of course, today is Super Tuesday. There seems to be that very strong chance of a sort of Trump winning out or taking out the presidential nomination there. I mean, is there a bit of a sense of unease on markets? I mean, is the market adequately pricing in this possibility?
You know, I'd like to say that the market is a little bit tense about this, but really not. You know, the polls and the off-site betting houses, et cetera, clearly have put in Trump ahead, and I think the markets have factored that in. Whether the markets are happy about it or not is a different story. I just think it's been factored in. It's not really a big influence on our market on a short-term basis right now. Yeah.
So I mean, if there's any sort of upset, you know, you don't think that this could show up in the stock market?
No, I don't think so. Not now, because I just think the market's looking past that right now and a lot more worried about currency stabilization in China, a lot more worried about the growth and inflation prospects in Europe and also here in the United States. I mean, can we keep this economy rolling?
Yeah, absolutely. I guess one of the other catalysts this year is going to be all about the Fed, isn't it? You know, what their plans are. I mean, on one hand, we are seeing this strong economic data coming through, as we've just been talking about there, Larry. But on the other, we still have a lot of this market volatility. I guess central banks adopting negative interest rate policies. Do you think the Fed expectations are a bit misplaced at the moment?
Yeah, I mean, I guess I think the market is actually mispriced at the moment. And I think the Fed's dots are too high. So somehow, some way, they'll meet in the middle by the end of the year. I do think the Fed's future interest rate dots forecast will have to be lowered towards the market. But on the other hand, the market right now is only pricing in one rate hike this whole year. I still believe there's going to be two, if not three, solely based on wage inflation and general inflation that we continue to see. And if you look at history, we know that inflation is one of those things that's very, very hard to predict and hard to contain. And I do believe that we'll have at least two, if not three, rate hikes this year to chase down inflation.